I am Claire Di Nicola, and I'm a consultant with PIA, and I work with PIA on a lot of these webinars, particularly excited about this one and this topic, and I know many of you are as well. We got lots of great questions in advance, so I'm going to be asking those of Chris as we go through. But as I said, we're also ready, willing, and able to take your questions live as well. So feel free to put that in the chat. I'll be monitoring that, and we'll be getting as many of those in as we can. Just before I introduce Chris, I just want to give a quick plug for this session is part of PIA's Summer Leadership Series. We have another webinar on July 14th at 2 p.m., which is about training tomorrow's producers. So if you haven't registered for that and the topic is of interest to you, please go ahead and go onto the PIA site and register. We can also add the link in the chat for you to be able to do that. All right, so without further ado, he's back for a repeat performance. He did a performance last fall. I attended. It was excellent. He's kind of the deal maker's secret weapon, Chris Hughes, Managing Director at Merger and Acquisition Services. PIA thanks Merger and Acquisition Services also for all its support of PIA. He's a longtime friend of PIA. He has lots of experience, many years of experience advising on deals. And I suggest to you, just from hearing him talk and interviewing him for PIA Connection Magazine, he's probably heard everything in terms of all the different scenarios and can give some really good information to us all today. He was a great expert resource. We did an article last fall in PIA Connection Magazine called Maximizing Your Agency Value. And he talked there about everything from the importance of financial discipline and having clean data, so prepping your agency to be sold or something in the future, to the value of carrier relationships and the current state of the market. So without further talking from me, who's not who you want to hear about, let's hear from Chris. So Chris, we'll have you take it away.
All right. Thank you so much, Claire. So this is Chris Hughes. I'm with M&A Services, Merger and Acquisition Services. I'm the managing director here of our insurance distribution platform. And what I head up is everything insurance agencies. That's retail agencies, wholesale agencies, MGAs, MGUs, any type of firm that touches the sale of the insurance product. That's what I head up. Our firm, M&A Services, does both carrier transactions as well as distribution transactions. So we work with all the major carriers as well as all the major distribution firms or agencies. I've been with M&A Services for 16 years now. I started January 1st of 2010. The firm's been around since 1998, so we've done a lot of insurance transactions, again, both in the carrier space as well as in the distribution space. Putting this presentation together, I've given this for a few different organizations. Steven Scales is our senior associate, helps me put together the marketing materials, helps me on all of the deals, all the distribution deals that we work on. But that's a little bit about me and a little bit about our firm. This presentation, if I went from start to finish without taking questions, runs about 35 minutes. So with that, I'm just going to dig right into it. What we're going to talk about today is primarily the M&A process from start to finish. And within that, I've included a few slides on insurance agency valuation and a couple of deal structures for you to take a look at. So if everyone can see my screen here, we're just going to go through the presentation. So the key objectives, when you're thinking about an M&A process from a seller's perspective, the number one objective for all sellers, no matter their circumstance, is really to monetize their investment. A lot of insurance agency owners, the insurance agency is their largest asset, many times larger than their house. So this is the biggest asset of their personal portfolio. And the number one objective is to monetize that investment. Other rationales that we see or objectives that we see when someone's looking to sell or merge with another agency is to grow the agency. And that can be through access to different markets or carriers or products. It can be access to capital. So I have a deal going on right now where the seller is looking to sell a substantial portion of their agency, but they're also looking for a capital partner to help them make 5 additional acquisitions post-closing. So it's access to capital. We've seen other MGAs that might want to sell to a larger MGA platform where they can have access to that larger platform's distribution channel. An example would be if an MGA is looking to sell to a Hub International, and Hub International has its own MGA division that allows them to access all of Hub's retail distribution. So just a few other reasons or key objectives for agencies to go through an M&A process. Enhanced revenue and expense structure, that's often and a likely outcome of when someone sells their agency to a larger platform. If you're a small agency with $1 million of revenue and you're doing business with the Hartford, you're probably on one commission structure. But if you're doing $100 million of revenue with the Hartford, you probably get an enhanced commission structure or a guaranteed override with carriers, so you can enhance your revenue economics. As well as when you're a small agency, everyone has their own agency management and IT cost and your own IT person, you have your own HR person, there's a lot of redundant expenses that you might have when you join a large agency. So one, you can enhance your revenue, and two, you can make your expense structure that much more efficient. So it just makes for more efficient, better run agencies. Another reason that you see, especially for younger agency owners, would be outside business interests. So anything from, hey, I want to sell my agency, I want to run it for a couple of years to get to an earnout, but then I want to go do something else. Or I've had a small commercial agency owner sell their agency because they came up with an idea of, I got this specialty product and I want to start a specialty MGA from scratch, and I think I can do that. Just outside business interests that other than the day-to-day of running their insurance agency. And lastly, strategic opportunities. So right now, and for the last maybe decade, there's been a lot of private equity money that's been in the insurance space that backs a lot of the buyers out there. So a lot, like for example, World or Trucordia, they're owned by private equity firms, majority owned by private equity firms. So when you do a deal, you might get a 75 or 80% cash at closing consideration, but you might have the opportunity to invest 20 or 25% of the closing consideration in World or Trucordia or other privately held stocks. So it's a strategic investment that's not really available to the general public. So that's just another, not really a key objective, but it is an objective for many agency owners as they go through the process. But again, the biggest one is to monetize your insurance asset. This slide right here, M&A sell side process overview, this is the entire deck that we're going to go over, right? There's 3 stages to the M&A sell side process. There's stage 1, the preparation phase, that takes from 30 to 45 days. There's stage 2, the marketing phase, again, takes 45 to 75 days from start to finish of that stage. And then there's the due diligence and contracting phase that takes another 45 to 75 days. But there are 3 very distinct phases of every M&A process. Going through this is, within, at least in the insurance agency world, from start to finish, you run this process, you're very likely to get to a successful conclusion to selling your agency. Stage 1, so first we're going to gather some information, and I'm going to share a redacted information request to show you what that might look like. From gathering the information, we're going to gather some of the financials. We're going to create pro forma financials, pro forma income statements specifically for your trailing 12 months. And that pro forma income statement is going to define what the pro forma or normalized revenue and expense structure looks like to get to a normalized EBITDA. EBITDA being earnings before interest, taxes, depreciation, and amortization. All insurance agencies or valuations are based on a multiple of EBITDA. So coming up with that pro forma and defensible EBITDA number is step 1. Once we have that and share that with you, we'll share with our sell side clients, hey, this is what we think the pro forma EBITDA is. These are the adjustments that we've made after talking with you. Here's what we think the valuation of your agency is. So that's like step 1 to even determine if you want to sell your agency is, well, what's my agency worth? Once we've developed those pro forma financials and agreed with our seller client, then we develop a anonymous fact sheet. It's a 1-page teaser. I'm going to share an example of what one of those looks like later on. We're going to develop a, say, 25 to 40-page confidential information memorandum, which will include the name of the company. It includes the location, products, sometimes an anonymous, sometimes anonymous, salary roster, key executive bios. I mean, it's really kind of a mini 10K for a privately held business, 10K report. We'll develop a list of buyers and determine, are we going to run a very targeted process and only target these 7 or 10 buyers? Or are we going to a much broader universe and run in a full auction with 25 or 30 buyers in there to see if we can get the very highest number? It's really dependent on what the seller is looking to accomplish in this. So all of that happens in the first 30 or 45 days. The faster the seller is when responding to us, the faster especially the financials come over to us, the faster we can do it. So it's about a 30-day back and forth process to develop all of the marketing materials, develop our buyers list, and go to market strategy. Once we have a finalized SIM, teaser, non-disclosure agreement, and our buyers list, and we've all agreed to it, we enter stage 2, and that's the marketing phase. That's where we're going to go out and contact the buyers. We're going to put non-disclosure agreements, NDAs, in place executed by the seller and each individual buyer. Going back and forth with that, if we send out 20 non-disclosure agreements to 20 different buyers, we're going to get 18 of those back that are redlined, especially when you go out to private equity buyers. We're going to get some that says, hey, we don't want to use your non-disclosure agreement. We're going to send you our corporate non-disclosure agreement. And then the seller has to go through each one of those and say, yes, these are acceptable or not acceptable. We know kind of the market for that, so we give a pretty good template with an NDA that's acceptable, I'd say, in 70% of the cases. But again, it's a process. It takes about 2 weeks, 10 to 12 business days to go back and forth with the different red lines to get fully executed NDAs. Every time an NDA is fully executed, then we send that specific buyer the confidential information memorandum, the SIM, right? That is the 25-page, 10K kind of report that I just mentioned. That SIM, the buyer then has a week to read the SIM, socialize it internally with their other investors or their executives to determine if they really want to make a run at buying this specific agency. After about a week goes by, we start setting up either team and Zoom calls with the sellers and with the decision makers of the buyers. That can, depending on where the agency is located, those can also be in-person meetings. So if you're in a convenient location, New York, Chicago, near big cities, or if it's a large agency deal, we can do in-person meetings. It just takes a little bit more coordination and time. Having a Zoom call that runs for 1 to 2 hours is much more efficient than trying to have an in-person meeting in Tampa and then having a dinner afterwards. That's a 6-hour process. But again, those in-person meetings can, for a larger size deal, the in-person meetings can make a world of difference versus having just a Zoom call. Once we get through those meetings, that process takes a few weeks, anywhere from 2 to 4 weeks, depending on if you're doing in person or Zoom and how many of those meetings you want to conduct. Then we solicit letters of intent, or an LOI. Letters of intent are written offers. Most of the provisions of the letter of intent are non-binding, although there are several provisions that are binding, including an exclusivity provision, meaning once a seller and a buyer sign a letter of intent, it generally has a 90 to 120-day exclusivity period in there that says we're not going to talk to any other buyers. We are off the market. We're just going to negotiate with you and get to the finish line. I'll show you all of the key provisions that go into an LOI and some of the key terms within those provisions in a couple of slides. But once you enter into a signed letter of intent with one specific buyer, you finished the stage 2 or the marketing stage of the process. Now you're just dealing with one buyer, and you're going to go through stage 3, which is the due diligence and contracting stage of a process. And that runs anywhere from 45 to 75 days. Generally, I would say, 60 to 75 days is more the norm than 45 days. It would have to be a pretty straightforward small deal to happen in less than a month. But in there, you're going to go through we'll create a virtual data room. The buyers will give us a due diligence request list. Sometimes that's in Excel and it can be very overwhelming because it's very detailed. It does financial diligence, legal diligence, operational diligence, HR diligence. I mean, it really goes through a laundry list. And I'm going to go through some of the things that go into diligence, but diligence itself is a whole separate webinar. And it's not a very fun procedure. Stage one, preparation and finding out, hey, I got this, I'm doing $2 million in revenue and all of a sudden my agency's worth $8 million. I had no idea. That's great, right? That's fun. Stage two, marketing, and you're going through these meetings and you have all these different buyers telling you how great you are and how great of a business you've built. Well, that's fun. Once you sign an LOI and you're in diligence and everyone's like, prove it and show me all of your bank statements and show me all of your carrier statements and show me all of your contracts. And you forgot this contract and we need to assign this lease. That's not fun. So stage three, this 60 days, while necessary, is not the funnest stage of the process. In this phase, you may also have other in-person meetings or virtual Zoom meetings. The buyer will likely hire an outside attorney. The buyer will hire an outside financial diligence firm to conduct the diligence, depending on the size of the deal and complexity of the deal. So you'll have generally virtual meetings with them. Everyone's going to be in a data room, answering questions, responding to things. In general, if we've done our job correctly in phase one, and we developed very coherent, defensible pro forma financials, when we get to due diligence, it's supposed to be confirmatory due diligence. You told us this agency was doing $4 million in revenue and $2 million in EBITDA, and here were all the adjustments, and here's the salary roster. We're just going to confirm this. We want you to prove that all of that revenue came from commission revenue from these carriers. We want you to prove that your expense structure, that your compensation structure is X, Y, and Z, what you told us in the SIM. Any of the adjustments that you've taken out, right? If you had a boat expense that was running through the SIM, we want you to prove that you spent $25,000 on your boat last year and that ran through your income statement. So diligence is supposed to be confirming what we've already told the people and what they put their offer in stage two. At the same time diligence is happening, you're going to go through a legal process where the buyer is going to hire a third-party outside attorney. That third-party outside attorney is going to prepare your main document, which is the purchase agreement. That can be a stock purchase agreement. That can be a asset purchase agreement, most likely an asset purchase agreement. If you're an LLC, it can be a membership interest purchase agreement. But they will provide the first draft of that. The seller's attorney will then mark that up and it'll go back and forth. The seller's attorney will have to develop schedules during this phase. You'll have employment agreements, you'll have executive employment agreements, you'll have producer agreements, you'll have bill of sales and some ancillary documents that goes along with it, but it's primarily the purchase agreement that happens at the same time that diligence is going on in stage three. At the end of the contracting and diligence, you'll have generally a simultaneously signing and closing. Generally, this is virtually, and then you'll have the flow of funds memo that says, hey, where does all the proceeds go? It's a closing, generally a Zoom call like this, and you'll have the buyer's attorneys, the seller's attorneys, the buyers and the sellers, and us on the phone, release all the signature pages, and your deal is closed to release the funds, and there it goes. So from start to finish, that is the M&A process, and this slide really kind of, really narrows down exactly what's going on and what's delivered at each stage of it. So I'm just going to pause there before we get into the details of each phase of that. Claire, if there's any questions, so I can't see the chat.
There are. And I'll encourage more people to put them in the chat, but we got some in advance. So this first question, Chris, relates to even before you get to stage one, before the process. So are there things, somebody asked, it's actually a two-parter, but are there things an agency can do to make itself more valuable early on? You give the time period before they even get to that stage one, and then run it efficiently. Do you have thoughts on that in terms of what you've seen?
Sure. In preparing your agency for sale, there's a couple of things. One, if you were looking to make any material big changes, positive or negative, right? I need to let go of this person or I need to hire a person to make those changes prior to the sale and make sure it's a good fit, especially if you're making a key hire or if you're letting someone go and having that run through, letting somebody go, a key person go, and then running the agency for 3 to 6 months to make sure that you don't need a replacement resource there. That adds credibility. Having your accountant look at your financials and making sure that there's an accountant's stamp of approval. You don't need audited financials. Mostly people run with internal financials, but having an outside accountant that runs your tax returns, take a look at your financials, making sure that you know what's run through there so that you can anticipate questions in diligence, anticipate and be able to answer the questions in diligence on your financials. That's important. Um, if you're going to do any kind of big IT changes, anticipating what those are, what those costs are going to be, and what the timeline is going to be. You don't have to actually do them, but if you're thinking you're going to sell in the next 3 years and you're thinking about doing this over the next 3 years, maybe do that year one and have that already implemented prior to doing it. You might want to talk to myself or an M&A advisor like me and say, hey, we're switching from AMS 360 to XYZ system. And if no one's ever heard of an XYZ system, you might want to say, hey, maybe we just stick with AMS 360 because that would be a little bit more acceptable in the marketplace and easier of an integration with most of the buyers. Things like that. I think you just anticipate, hey, I'm getting ready for sale. You might want to contact an M&A advisor, 6, 12, 18 months prior to sale, get to start to develop a relationship there. And M&A advisor is also going to be able to recommend insurance transaction attorneys for you, insurance accounting firms for you if you don't have one. I mean, we have resources. We've done so many deals that you just develop kind of a really big Rolodex of different resources that you may or may not need, but definitely having someone like this in your corner helps a lot.
And you just answered another question, which is somebody asked for resources. So the resources they need: good accountant, good attorney, M&A advisor.
Yeah,
Uh-huh.
primarily in the M&As and selling your agency, the primary resource you need is an M&A advisor. I mean, I don't want to make this a commercial, but the primary resource that you need to maximize the value of your agency is an M&A advisor that focuses and only does insurance agency transactions.
Mm-hmm. Okay.
From there, that insurance agency advisor should have plenty of attorney recommendations for you that are efficient for an agency, for your type of agency, whether that's small P&C agency, whether that's a employee benefits agency, whether it's commercial, personal lines. It doesn't matter. We'd have whether you're in California, New Jersey, Florida, we'd have appropriate resource recommendations for you. The second person that you're going to need is a good M&A attorney that focuses on the insurance industry as well. So those two specific advisors that should get you through a process.
Okay. We're getting a bunch of questions. These two came in advance and you kind of touched on them. One was about somebody who's retiring in 3 years. And you did use the model of, if you're going to sell in 3 years. Are there specific aspects related to retiring that should be considered there, or?
Yeah, so absolutely. So later on in the deck here, we're going to go through two specific deal structures. And almost every deal that we see has a closing consideration, cash component at closing component to it, but oftentimes, almost every time, there's a 2 to 3 year earnout period. So if you're thinking of retiring in 3 years, you want to be there for your earnout period if possible. So you should sell now and work for the buyer for a 2 to 3 year period. The earnout can add another 25 to say 40% of value to the agency if it's growing. Most earnouts these days are growth based, and they have like a 3% say hurdle rate to it. So you have to grow up more than 3% before you start getting into your earnout proceeds. So if
Okay.
you're thinking of retiring in 3 years, it's better to sell your agency in year one and then stay for year two and year three through an earnout period, so you can maximize and have control over that earnout. Whereas if you sell your agency and you retire, which you can do, there's generally no earnout that goes along with it. You can do that for sure, You're just leaving a little bit of upside consideration on the table.
So somebody just actually asked that. They must have been reading your mind. If you sell and walk away, how does that lower the sale price? You just said it does. Do you have?
So it doesn't lower your sale price, but it lowers your control over your ability to hit the earnout to
Ah,
make the agency grow.
okay.
So the earnout is still there. You're not there, so you can't make decisions that would help your agency grow into that earnout. So
Okay.
if you have a big, large agency, you have a great bench, and you're an absentee owner, and you just walk away, no harm, no foul. That earnout's still there with you. We're doing a smaller project right now. The donor was looking to retire in 6 months. The the buyer made such an offer that says, hey, we really want you to grow this agency just for a period of 2 years, and put such an incredible earnout in front of her that that's what she's looking to do. And she's like, yep, I can definitely do it for 1 year, if not 2 years. And if I decide to leave after the year, the earnout's still in place. So
Mhm.
it just depends on the deal structure. And as you get into the process, as I mentioned, it takes 6 months to go from start to finish. So if you're looking to retire in 3 years, by the time you finish the process, you got 2.5 years left.
Great.
But there's
So,
plenty of buyers that will let you walk away the day after closing.
Chris, we have a number of questions about specific mix of business and lines. Should we hold those to later and how that affects valuation?
Yeah. Let's go through the next part of this, and there's a slide here that shows some of the valuation drivers. I'll pause there, and we can talk. Well, I'll probably cover some of the
Okay,
valuation drivers, which covers a mix of business.
great.
All right. So the first thing in the preparation phase is gathering some information. So we'll send you a list like this, and what we're really looking for is the last 48 months of income statements. This can come from QuickBooks. This can come from your agency management system. If it's in Excel, that's great. A current balance sheet and your full year revenue projections for the current year. This will be in 2026 and possibly next year, 2027. If you're using one of the major agency management systems, we would look for a full book of business report for last year and year to date this year. That would be a huge Excel spreadsheet of like a data dump of everything that's in your agency management system. Sort it by premium, commission to your agencies, producer commissions, carriers, clients, producers, line of business, type of business, state. I mean, it goes through a laundry list. It's a big Excel file that we're able to slice and dice and say, okay, let's slice this and say how much of it is employee benefits, how much of it is personal lines, how much of it is commercial lines, how much of it is personal auto, how much of it is commercial auto, right? How much business was produced by producer A versus producer B versus producer C. We can slice it by what are your top 10 carriers by premium, what are your top clients. So what we're looking for is to come up with carrier concentration, client concentration, producer concentration. What's the book of business mix look like, right? So it's just a book of business report, and it looks different from different agency management systems, but if that can be downloaded into Excel, so much the better. We ask for a salary roster. Since you're just giving it to us internally, the name is fine. We may anonymize this when we put into the confidential information memorandum, but we're looking for a salary roster that shows the name, position, salary or commission structure, bonus structure, benefits that they take, whether that's health insurance or 401k, just a full-on salary roster for the current, last year and what it currently looks like. The IT systems that you utilize, so that's your agency management systems, that's your QuickBooks, that's your Microsoft products. Most recently, if you're using Claude or ChatGPT, we're looking for your key lease terms, if you have one or more leases, depending on your operations, and whether the owner of the agency also owns the business. And then we're looking for just some general information about the agency. Are you a S corporation, limited liability company, LLC, or are you a C corporation? That matters in how we might structure the deal, and it definitely matters from a tax perspective. We look for ownership information, who owns it, whether you're the sole owner, whether you have more than one owners, whether it's owned by a trust. I mean, ownership information is there. We're looking for the states that you're licensed and doing business in. And and then we just put in E&O claims and lawsuits within the last 5 years, but that we also have any kind of acquisitions that you've done, any kind of book purchases that you've done, any major material events that have happened with your agency in the past 5 years. So this is part of stage one. You say, yep, Chris, we'd like to talk to you. We send over something like this that's a little bit more detailed, which also fits on one page of a Word document. So this is the information that we would request from each one of our sell-side clients. From the financials, we would look at the trailing 12 months, the last 12 months. This is a truncated income statement. Over here on the left column is the actual income statement. So this agency had $5.5 million in commission and fee income, $400,000 in contingencies, around $100,000 of interest and other non-core income. So a total revenue of $6 million. You run through their expense structure, and they had $4.4 million in expenses and just over $1.6 million in EBITDA. Again, EBITDA is earnings before interest, taxes, depreciation, and amortization. On an actual basis, this was about $1.6 million. We make some adjustments to that. So we take out all interest income and interest expense. We take out any kind of non-core income. This can be, in this example, I believe it was the sale of a life insurance policy to the owner's wife. So that's non-core, non-recurring revenue. We would take that out. Because if you don't take it out now, you're going to get into diligence, and the buyer is going to say, hey, that's not really recurring revenue. That's non-core to your business, right? So you're trying to make all of these adjustments on the front end so that there's no surprises or adjustments through the diligence process. And then on the expense side, so we normalize this to what it would be under a normalized kind of corporate umbrella, taking out all things that are personal to a privately held insurance agency owner. So in this circumstance, we normalize the agency owner's compensation to what is market. We take out the wife's spouse that was on the payroll for benefit purposes, but not really doing any material operations to the business. And then you make it so we take out $236,000 of payroll expense. And then any benefits or payroll taxes that's associated with that, we make that adjustment as well. So make $273,000 of total compensation adjustments, right? It's as though this owner wasn't making an excess salary, and it's as though this owner didn't have their spouse running through the payroll. We make any kind of selling expense adjustments. This can be, in this circumstance, it was country club dues, personal travel, there was a personal car in there, and a personal boat expense. All the things that you might want run through your small business, privately held small business, but that are not necessary to the running of the business. Other things that we see in here for selling expenses might be charitable contributions, personal college tuitions. A lot of times you have family members that are running through the expense structure, kids that are at college. Another big thing is you might have producers that are, say, earning a 50-50 commission split, 50% new, 50% renewal, and you're like, hey, we're going to bring you back down to what the market is on a 40-35 or a 40-25 split going forward. It's not in this agency. This was owned by a bank, so this was pretty corporate to begin with. There wasn't that much running through there, but you might have commission split adjustments. So if you have that and you're paying someone 50-50 before, and now you're going to adjust them to 40-35 at the sale, that's going to decrease your commission or your selling expenses. In general, when that happens, you're going to allow that producer that's being normalized to a normal compensation structure going forward. You'll use some of the transaction proceeds and you'll give it to them. And you'll say, hey, I know I'm going to take your commission down from, last year you're making $250,000. This coming year you're going to make $200,000 because of this difference, right? That's a $50,000 annual hit for you, but I'm going to give you $400,000 of the value of this agency to do that and for you to play ball and be treated like a partner with me. So that's generally how that works out. You have any kind of one-time adjustments for administrative expenses. That can be a one-time IT expense if you just put new servers in last year. If you have any one-time professional fees, if you hire an M&A advisor like that, maybe you'll have, like us, you might have a one-time fee in there. If you had an E&O claim and you had to hire an attorney for $15,000, some things like that. One-time non-recurring expenses you would take out. If the owner owns the building and it is not a market rate rent, you might make a upwards or downwards adjustment to normalize the rent occupancy expense for that. We have a client right now that has 6 locations. One of the locations has nothing to do with insurance, but it's owned by the insurance agency, so we adjust out that entire location. And then you have all of the interest expense, income tax expense, not payroll tax, but income, federal and state income tax expense that comes out, depreciation and amortization, all of those kind of below EBITDA expenses comes out. So we make all of these adjustments, and what we're again trying to do is get into all of the buyer's head, make these defensible adjustments. So now we've got $5.9 million in revenue and $2,045,000 in EBITDA, in pro forma EBITDA. So that 2.45 is the base metric used for evaluation. Insurance agencies are based on a multiple of EBITDA, pro forma EBITDA. So for smaller agencies, less than $1 million of EBITDA, you would apply a multiple of somewhere between 7 and maybe up to 10 times to that $2 million, right? For a $2 million agency, that can be anywhere from 8 to 12 times multiple of EBITDA. And if you're greater than $3 million of EBITDA, you'll attract a lot of standalone private equity investors, and your EBITDA goes, and your multiple gets even higher. So the larger the scale of your agency in terms of both revenue and EBITDA, here we're showing EBITDA, the higher the multiple trends. Some of the valuation drivers so that's a big range, right? You can go from, if you're $1 million, call it $1.1 million agency, that difference between a 7 and a 12, that's a big range. What are some of the drivers that matter there? The organic growth of the agency matters a lot. So if you're growing at 10% compounded annual growth rate for the last 5 years, that matters a lot. Your client concentration and nature of those relationships. If you have, say, one client that makes up 40% of your revenue, that's a big client concentration risk. So you'll have to structure around that. The mix of business. So if you write, non-standard auto, that's different than middle market commercial business. If you write individual healthcare, that's different than middle market employee benefits that write, 50 to 200 live accounts. So generally, it doesn't matter the mix of business in terms of, is there a market for it? The market's going to change. So personal lines is going to have a different set of buyers than your small commercial to middle market, which will have different buyers than that. Your employee benefits will have different buyers than your individual health care. Having a good mix of business of each one of the lines, diversifying that, can be a very solid indicator as well. In general, non-standard auto and personal line trades for probably the lowest of those ranges of multiples. Personal lines, with the advent of AI coming into the picture in the last 6 months, it has depressed a lot of the publicly traded broker multiples, and that has, bled into the private market a little bit, but it's more on the personal lines that people are concerned with on whether AI is going to really disrupt the personal lines distribution model. Having a management, so if you're an owner operator and you are the business, that depresses the multiple a little bit, as opposed to having, you're one of 5 managers that's in place there. Having a good system in place and a good agency management system in place matters. Having good contracts in place with your producers. So if you have 4 producers, but you don't have any kind of non-solicits or non-competes in place with those producers, that can drag down the multiple. Having solid contracts in place with your producers, having solid contracts in place with your carriers, and having good products and services to sell can make the multiple a little bit higher. Here, as we're going through the preparation phase, here's just a illustrative assortment of different buyers. So for retail, small retail insurance agencies of say less than 3 million of EBITDA, less than say 5 million of revenue, most of these public brokers and private strategics would be the buyers that we would target. And depending on if you're an MGA or a retail agency and the size and the mix of your business or the location of it, right? King Insurance focused mostly east of the Mississippi. Happy to look at personal lines, happy to look at commercial lines, happy to look at small deals all the way up to larger deals. Hub International announced they're going through they're looking at the IPO this year, but they are all over the place. So if they buy small things, they buy personal lines, commercial lines, all across the board. If you're an MGA, you might focus on someone like ISC or Ryan Specialty. Once you get over $3 million in EBITDA, $5 to $10 million in revenue, then you can attract some of the private equity buyers. And here are some of the ones that are in the marketplace that currently own or have owned insurance distribution firms. Most of these have current investments in a lot of the players over here on the right. But you're developing your buyers list, and this is just an illustrative example of some of the buyers that are out there. In terms of deals that people did last year, Broad Street Partners owns 31 large platform agencies, and those 31 platform agencies did a total of 69 announced transactions last year. Hub International did a lot, InsureZone did a lot, right? And this shows who the private equity backer is for each one of them. You do have some that are purely private, like Levitt Group, and you have the public brokers, AJ Gallagher, Marsh, Aon. Aon acquired NFP, which is a very prolific middle market, small commercial and middle market buyer out there. But those are the major buyers and who was doing a lot of the deals last year. When you're developing a teaser, this is a real example of what a fact sheet or a teaser is. This tells about the company without saying the name and without giving any information that would identify who the company is. So this is the one-page teaser that we would send out to every prospective buyer along with a draft non-disclosure agreement. Show the premium volume, net revenue, pro forma EBITDA, what it looks like here on the bar chart of 3 years of financials. Does business in 48 states. It's an Illinois S corporation, has a specialization in fast food franchises and habitational P&C business. This is its mix of business by revenue. It just gives buyer, hey, just really quick, am I even interested in signing an NDA and looking at this business, right? Mm-hmm. We would develop a SIM. We're not going to go through a full example of a SIM, but here's the table of contents of a SIM. Here's the transaction and process, the timeline, right? We're putting NDAs in place, sending out SIMs. We are having management meetings for these 3 weeks. We have a letter of intent bid deadline due date. We're looking for diligence to happen in these 8 weeks, and then we're looking for a closing in this month, right? Transaction and process. We'll go through the corporate highlights of the business. We'll have a couple of pages on the financial highlights, a business overview, a breakdown of its products and services, the various carriers, how the agency goes about marketing and sales and where it comes from. We might have a anonymous key executive bios the key executive bios would not be anonymous, but we might have a page or two of key executive bios as well as an anonymous salary roster in there. any kind of key accounts or client concentration, ownership information, and then we would show the actual income statements, the pro forma income statements, and an explanation of every adjustment that we made to it. Then we would show it on an unadjusted basis as well as the balance sheet and income statements. Stage two, we're running the controlled auction. Again, we're going to solicit interest by sending out that blind profile that I just showed you, this being the blind profile. We'll get executed NDAs in front of everyone. Again, that takes about 2 weeks to go through. We'll distribute the SIMs to everybody out there. We'll conduct principal meetings over 2 weeks, 2 to 3 weeks. Determine, you might have a meeting and these meetings are for the sellers to ask the buyers questions, and you might say, hey, after meeting with them, there's no way we would be a fit there. We don't think we'd want to sell to that buyer. Or, hey, can you really pursue that buyer? We thought that meeting went great, and we think that'd be a great fit for us. Then we solicit letters of intent. We negotiate and execute a final LOI at the end of the auction process. So a letter of intent includes whether it's assets or a stock to be purchased, any liabilities to be assumed. Often it's a lease agreements that would be assumed. Letters of intent tell you what the price is, often how the price is determined, and the main terms of the offer. There'll be an exclusivity period provision in there that says, hey, you're not going to talk to anybody else for a period of, say, 60, 90, 120 days. Most LOIs have an expiration date saying if they give it to you on Monday, it expires the following Friday. They don't want their LOIs to sit out there forever. Most of them have a due diligence clause, meaning that this LOI is subject to completion of satisfactory financial, operational, legal due diligence, and it'll have a estimated closing date in there. So all LOIs have these provisions. Within the LOI, the terms and conditions, they'll spell out how much of it's going to be cash or equivalents being like AJ Gallagher stock, if it's 80% cash and 20% AJ Gallagher stock because it's publicly traded, that's an equivalent to cash. It'll spell out the terms of any performance-based earnouts, and they look a little bit different for different buyers. Any kind of buyer equity that they're offering or retained equity if you're keeping a portion of your own agency. The Levitt Group likes to buy, say, 70% of an agency, and you retain the other 30% of your own agency. Any key terms of producer or executive employment contracts, and the length of any non-compete or non-solicit agreements. In general, non-competes and non-solicits for the sellers of insurance agencies run a minimum of 5 years, as they're paying a multiple of 7 to 12 times earnings. Agreeing to not compete or non-solicit any employees or clients for 5 years is often expected and generally a pretty non-negotiable term. I'm going to show you 2 offers here. So this is acquires 100% of the company at a 12 times multiple. We're using this $2 million EBITDA number here, and they're paying 75% cash, and they're rolling 25% equity. Most of the buyers, the World Insurance, the Hubs of the world, Trucordias, show about a 25% stock appreciation over the past few years. So we've run that for 3 years in this model. And then they show an earnout where you're getting paid a 5 times multiple of any growth of EBITDA over a 3% growth hurdle rate at the end of each year 1, year 2, and year 3. So if you grow at 20%, you're getting the $18 million cash at closing. You're getting $6 million of stock that you can't sell. And then you grow at 20% at the end of year 1, you get 1.7 million. At the end of year 2, you get 2 million. At the end of year 3 and the earnout, you get another 2.3 million. So you get about, approximately $6 million of earnout consideration. And then we have the sale of the stock at the end of year 3. So generally, when a private equity group buys into a company, they end up holding it for a 3 to 5 year period, and you just don't know where you are in that holding period. So we just ran this out for 3 years, growing at a 25% compounded annual growth rate. So this could be total consideration of $37 million. This is what it looks like if you don't grow at all and you don't hit any of the earnout. Then you're getting $18 million cash at closing, and at the sale of your 25% equity roll, you get another $12 million. So that's total consideration of $30 million. These are expectations. This could be, maybe World Stock doesn't grow at all or Hub Stock doesn't grow at all. So that is a private investment. So it's not risk free, but in general, this is what they have been growing at. In this second deal structure, I'm showing more of a same multiple, same 12 times multiple, and you're getting 95% of that cash at closing. You're getting no stock, so it's all cash. And then at the end of year 2, they'll go back and they'll give you a 12 times multiple on what that year 2's earnings were, subject to a cap. So it gives you 2 years to grow. So this, from the buyer's perspective, it says, hey, we want you to grow and we're going to pay you on that growth. And we're going to take a 5% downside protection at the beginning. So we're not paying you 100% at closing. We're paying you 95% at closing. So it's a more cash heavy deal. There's no equity involved. So if you grow, the most you can make is $31 million. But again, you're getting 23 of that at closing. You're getting much more than in the first deal structure at cash at closing. So it's a less risky deal, but the differentials is $25 to $31 million in this structure versus 30 to 37 in this structure. So it can be less lucrative than in one where you take stock. But those are two deal structures that are very prevalent in the market today. Stage 3, once you've picked a letter of intent and offer, you'll get into stage 3 and you'll go through a very comprehensive financial diligence, operational diligence, legal diligence. So the financial diligence, they'll ask for bank statements, carrier statements, going back for years, for 3 years, 3 years of tax returns, 3 years of your internal financials, income statements, balance sheets, all of your agency management reports. Generally, the buyer will hire a third-party financial advisor or a CPA firm to do that diligence. You'll have their HR team go in and look at your company handbook. They'll ask for your salary rosters, your producer agreement, your employment agreements. They might want to meet with key executives depending on the size of your agency. In the legal department, they'll ask for your leases. They'll ask for every one of your carrier contracts, every one of your third-party contracts, your contracts with Microsoft, with your agency management system, for all of your leases. They'll look for assignment clauses. Can we assign this contract to the sale, or do we have to ask permission from the person that you've contracted with? They'll look for all of your licenses, for your agency licenses, as well as for each individual producer licenses that's there. So it's a very comprehensive, 75 to say 120-day process. At the same time, you'll have their attorneys will put together the purchase agreement and the schedules. You'll have employment and producer agreements that are being drafted, non-competes, non-solicits. You'll have some ancillary documents that are going back and forth with the buyer and seller, the bill of sale, the assignments, new lease agreements, things like that. That whole process is going on at the same time that diligence takes place as well. And the whole process takes about 6 months. I'm going to leave this up here for just a second, but the preparation phase takes anywhere from 60 to 75 days. The marketing phase, can take 2 months, 60 to 75 days, and then the diligence phase can take 2 to 3 months, generally about 75 days. So if you're looking at the whole process, can it happen in 5 months? Yep. Does it most likely take 6 months and happen in the 6 months? Yep. Can it take 7 months if something comes up in diligence that takes a little bit longer, or it takes a little bit longer to gather the financials and get to market? Or if you're going through the process, you sign one LOI, then for some reason you lose a large client or you gain a large client. I've had a deal where the buyer was Arrowhead. Arrowhead ended up getting bought by Brown & Brown while we're in the middle of diligence. Brown & Brown didn't want any acquisitions going on. So that delayed the process a couple of months, but Can it take longer than 6 months? Sure, if something happens. But in general, if you follow this process, you hire the right advisors, it's, a, there's a very liquid market for insurance agencies. It just takes 6 months to get there from start to finish. So I'm sorry, Claire, I took way longer than I
That's
thought.
okay. But I will tell you, we have really good questions. We will not get to all of them because we'll end at 3, but we will look at figuring out, first of all, Candace has put Chris's contact information, his age, his organization information. There it is on the slide as well. But let's just get to a couple and then we'll think about it. Can we get to a part 2 for some of these great questions? The first question that's I think is really good is, so you talked about the whole buying process. Are there red flags a seller should be looking at in a buyer? And this particular question related to earnouts, the feel that if too much is in the earnouts, could the buyer say they had to add more costs so that the earnouts weren't as viable or attainable? But there might be other
Yeah,
red
so
flags.
that's it. Yep, so that's a great question. Um, in general, the risk that you have in an earnout is the credibility of the buyer. So if you're dealing with these buyers that are on this list, if you're dealing with World or Acrisure or Choice, the Hill Group, Hub, Trucordia, they're High Street, King. If you're dealing with these buyers over here, or the public brokers, right? They're in the marketplace all the time. Generally, they're going to be very upfront with any kind of extra expenses and how they're going to run the business in the diligence process. So you'll have a clear understanding of how it's going to run and how it might affect your earnout and how the earnout is going to be determined. You'll have your attorney that is protective of your earnout in the purchase agreement. So I think the risk with the buyer with an earnout is if you're dealing with ABC company that you've never heard of, or it's a similar sized agency across the street from you that's making the deal. They don't have as much reputational risk that's in the marketplace. So I think you just need, if you're going to do business with somebody that's not doing a lot of deals, I think you just have to have your attorney be very protective of that in the purchase agreement.
Okay.
And you want these to be growth-based earnouts. So if you run a process and you get 3 offers, you want to get most of your consideration at close. If there's a holdback or something like that, you want that held in a third-party escrow account so that it's not the buyer that controls the money, but it's a third-party escrow that easily says, yep, condition A has been met. We went for 12 months without any lawsuits. This money's yours.
So Chris, I know we have a lot of smaller agencies on the phone, and someone asked, they're at 800,000 in revenue, and they're in a niche market though. Should they wait until they get to that higher valuation? Like, what are the considerations there? How should these folks be thinking about their agencies?
So if you're at $800,000, $1 million sounds a lot better than $800,000. I can tell you that. So having a specialty market, having a niche market at $1 million, absolutely is a great asset. $800,000, when you get into the hundreds of thousands of dollars rather than at least 1 million in revenue, it looks a little bit more like an owner operator business purchase, which is fine, right? The agency that I was discussing that we're in diligence with right now is just over $1 million. We did off the pro forma. There's about $400,000 of EBITDA. We got the multiples that was on this other slide here. So you can do that at $1 million, but at $800,000, it's right at that line. So if you're growing, and you're sitting here at the end of June, so if you're like, I did 800,000 last year, but I think I can get to $1 million by the end of this year, maybe you would build a pro forma and you would use the pro forma full year 2026 numbers to show $1 million. And by the time you get into diligence, you're going to be in the fourth quarter anyhow.
Great. And then we're going to end, but maybe it's good that you're on this slide. Can you just give an overarching of the trends you've seen? You showed us the number of deals, you showed us the valuations. Have they remained pretty steady in the last couple of years? You talked about the drivers and their impact. What are you seeing in the market right now?
Yeah, so on the larger deals, we think there's a little bit of downward pressure because the publicly traded brokers were trading 50 to 60% higher their price to earnings multiples were 60 to 70% higher 12 months ago than they are today. So AJ Gallagher's stock has gone from way up here to down here. So that's put a little bit of pricing pressure on larger deals. Does it really matter for a deal that is $1 to $3 million in EBITDA? Probably not, because they're still trading above, 10 or 11 or 12 times. But once you start getting into that 12 times and above, there's some downward pricing pressure I'm feeling in the market right now.
Okay, great. So
But for smaller deals, no, I don't think so.
thank you, Chris. We're going to have to end it here. Thank you all for attending, and thank you so much to Chris for his sharing his wisdom with us today. And we will figure out how we can get to the rest of these questions in other formats and other ways. Thank you, Chris, so much. Really, really informative once again.
All right. Thank you for having me. I really appreciate it.
Bye bye, everyone.
Bye now.